This is a special podcast presentation from 700WLW.com. This is Casey Boland On Demand.
Casey Boland, we talk money about this time of day. And Casey, interest rates right now are low, and in some cases too low for some. Investing in U.S. Treasuries right now is not going to get you much of a return.
No, I mean, right now it's a little bit over 2% per year. Yes, it's safe and secure. The government can pay you. They'll go down the basement if they've got a printed to pay you, but it's not going to keep up with inflation. So if you're looking for bond investments, something else to consider as part of diversification within your portfolio, you might consider something called floating rate bonds, or they're also known as bank loan bond funds.
And they work along the lines of a Treasury bond?
Well, they work very similar in that it's basically an IOU, but instead of being an IOU by the government, it's an IOU by a company. And what's different, though, about this type of bond is, a Treasury bond pays a fixed rate of interest, but with this type of bond, floating rate, hence the name, the interest rate, it works very similar to, like an adjustable rate mortgage. Mm-hmm. You're not investing in mortgage, but ARMs, the way they work, if interest rates go up, you have to pay the bank back a higher rate of interest, and that's how this bond works. If you're a bondholder, if interest rates go up in time, you're going to start to receive additional interest payments.
The bank has to pay you.
Yeah, that's right. There's some risk still involved with these bonds. The interest rate it's paying is between 3.5% and 4.25%. So it's a good deal, but it does come with a little bit more risk, credit risk that is. So a little bit more risk than your federal government as far as the issue of them being able to pay back money. But what's nice about these bonds as well is they go out and secure collateral to back up these bonds and making sure they can make these payments.
And you're saying right now it's about double the rate of return of a Treasury bond, so why not?
Yeah, it has a little bit more risk, but with every diversified portfolio, it's an area to be able to, I think, manage that interest rate risk, because with a typical Treasury, if interest rates start to go up in time, it looks like a teeter-totter. It could hurt the value of those bonds on the other side of the teeter-totter. These types of bonds shouldn't experience that type of risk with rising interest rates.
Okay. Casey Boland of Hang Ho Capital Management. We thank you, Casey, as always.